Welcome to Becoming a Financially Confident Woman, the podcast that helps high-achieving women take control of their money and build wealth with confidence. I'm your host, Dr. April Murdaugh, financial advisor, college professor, and founder of Woman to Woman Financial. I've got women through retirement planning, generational wealth building, and everyday money decisions. Beyond the credentials, I understand the struggles on a personal level. I've experienced widowhood, divorce, homelessness, and the challenges of being a single parent. Those experiences shaped my mission to help women like you gain the clarity, confidence, and strategies you need to take control of your financial future. This podcast is where professional expertise meets real-life experience, so you can move forward without fear or overwhelm. Let's dive in. Happy New Year, everyone. This is Dr. April Murdaugh coming to you in 2026. That is correct. It is January 4th, 2026, and I want to say Happy New Year to all of my listeners. I pray that you had a wonderful start to your new year. I know tomorrow everyone is getting back to work and trying to get back to a normal routine. And I wanted to start the new year off with a podcast, really educational, kind of give you some tips and ideas this next few episodes to talk about things that I find to be quite valuable. I think a lot of people come to me with a lot of preconceived ideas. And then when I share with them the benefits of these types of strategies, they are in awe. So today, I want to talk to you about annuities. I really want to help you demystify annuities. I want to explain to you what they are in very simple terms and just give you a very objective overview of what they are and how they can potentially serve you or serve the right person. So you've probably heard strong opinions about annuities, and some people love them and others say no way, others say run away. So today, what I want to do is I want to separate facts from fear. You know, I've heard a lot of stories from folks that have had family or friends or maybe even personal experiences with annuities, and they are fearful. The news, these commercials tell people that they shouldn't. You'll see some ads on social media and different things explaining why they're bad and focusing really on the negative. And there are some not so good aspects of it, depending on the right person. And so today I really want to take a deep dive into this topic because for the right person, this to me is an excellent tool, another tool that you can add in your toolbox as you prepare to create and grow generational wealth and as you prepare for retirement. So I want to start off by saying this is education. This is not a sales pitch, okay? I am not giving you a recommendation. I am explaining what this product or this instrument can do for you, what this strategy can do for you and for your loved ones. Not everyone needs an annuity, so I want to make that very clear. Annuities are not for everyone. They are for the right person, and we'll talk about what that person looks like in a moment. The right annuity depends on your goals, your income needs, and your risk tolerance. So again, it is not for everyone. You know, you can't use one type of tool to do all different types of jobs, right? You got to have a different tool for different jobs. You've got to have a flathead screwdriver for one. You may have to have a drill. You just need different tools, but they can achieve the same objective, okay? And so today I really just want you to understand that this is not a sales pitch. Not everyone needs an annuity. And the right annuity depends on your goals, your income needs, and your risk tolerance. So that's the first disclaimer that I want to share with you today. The second thing is really what is an annuity? I mean, you hear it's bad and you hear all the negative things about it, but what is an annuity? So in just layman's terms, an annuity is a contract with an insurance company. You give them money, and in return, they promise you income either right now or later, whenever you want to take it. That's really what an annuity is. Think of an annuity as your personal pension. You trade a lump sum for predictability and guarantees. So for those who may still work jobs that have pensions, may work in the school system, may work in the police force for their city or the state, they have a pension. And that pension says, well, if you work for us for 20 years or 30 years, they'll calculate how much money you will have put away. And using those calculations, they come up with an amount of money that you can receive monthly or annually for the rest of your life once you retire. That's your pension. And they have to guarantee, they make a guarantee and say, if you do X, we will do Y. And it doesn't matter if they have the money. Once they enter into agreement with you, they're obligated to fulfill that arrangement. Well, it's the same thing for you. As an individual, instead of having to work 30 and 40 years to get a pension, you can create your own private pension, is what I call it, and that is using annuities. So the most important parts are this. You are the owner. There's an owner piece to this. There is something called an annuitant or a person called an annuitant. There's the insurance company. And then there is an accumulation phase versus the income phase. And we'll talk about that. So the owner of an annuity is either the person who is buying the annuity, who's giving the insurance company their money. So I could be giving the insurance company my money in exchange for income now or income later. The annuitant is the person that's going to receive the money. And sometimes the owner of the contract is not necessarily the annuitant, but the annuitant is the person that when the contract has been fulfilled, now or later, they are the one that is going to receive the stated income for the stated amount of time. And then the insurance company, that is the company that is holding the contract. They are obligated to fulfill the contract that they've entered into with you, the annuitant and the owner. And the next thing is accumulation phase versus income phase. Well, sometimes annuities are set up where clients may want to wait. You could be 50 years old, you set up your private pension, you're not going to retire until 67. And so from 50 to age 67, you put $100,000 in there, and those 17 years, that money accumulates, and it accumulates a certain value. And in 17 years, it's worth X amount of dollars, $250,000. And from that money that has been accumulated, they use that to calculate how much you're going to be paid out over a stated period. There's an income phase. The income phase is when you reach the age of 67, then you begin to take income from that. And so those are the two things that you'll need to understand. There's an accumulation phase where you leave the money in the insurance product and you allow it to accumulate, to grow. And then there's an income phase, and you decide that at a specific time that you and the insurance company come up with, you're going to take an income from that annuity. Now, there are 3 different types of annuities that I really want to highlight, a few different types. The first type is what you called a fixed annuity. A fixed annuity just gives you stable, predictable growth. You're not earning a lot of interest on it. It protects your principal. So if you put $100,000 into this pension plan, this annuity, no matter what happened, your principal is protected. Okay, so at the end of the period, you will at least have your principal back. It's often used for conservative money. People who are very conservative may do a fixed annuity. The accumulation, the interest is not a lot, but because it's pretty stable, it's predictable growth, and because their principal is protected, in some cases, for the right person, a fixed annuity could be a good thing. Then they came up with something called indexed annuities. And the indexed annuities are annuities that are tied to a market index. The S&P 500, Barclays, they may be tied to a different market index. And what that means is that you will get a certain percentage of the index growth over a period of time. And they may calculate that each year that you have the annuity. The benefit of the indexed annuities is that there is something called downside protection. So because it's tied to a market index like the S&P 500, we know that the stock market is not stable. Today it's one amount, tomorrow it may go down. The next month it may go up. So we know that there's some volatility and there's going to be change in the stock market and how it grows. And what an index annuity does for you is say, hey, we don't care what the index does, so how it performs over the length of time. Even if it goes to negative 20%, you will not lose any money. So the most you can lose is zero. The furthest down you can go is zero. And as the market index increases and gains, the most you can get is a certain percent of money. So because your downside protection is zero, your upside is capped. So if the market does 15%, well, that type of annuity, depending on the way it's structured, the max you can get would be 10% of that. So that is what an indexed annuity does. The upside is capped. So they may say, hey, we earn 15%, but we're only going to give you 10. Or they have a limitation. They don't care what happens, but you're only going to get a certain percent of the upside potential. And a lot of people tend to like these because of the downside protection. The next type of annuity is called a variable annuity. And a variable annuity is tied again to the market, and the annuitant or the owners, they can invest in sub-accounts. So they can invest in mutual funds within the annuity. They're similar to mutual funds, but you can invest in them and you can earn, again, some of the upside of the market, but you will earn some of the downside. So when the market goes down, it will decrease the value. And if it goes up, of course, you'll earn more. So it does, it is tied to the market. It doesn't have a downside protection per se. But those annuities tend to have higher growth potential because if you think about the market, the way folks make millions and millions of dollars is investing in the stock market. And so variable annuities allow you still to have some protection as an annuity to get some guaranteed or some income at a stated period of time. It has higher growth potential, but most of all, you have sub-accounts that you can invest in that are similar to mutual funds. There's more risk in that, right? Because we know that the market is, volatile. It changes depending upon how you invest. There's more risk, and there are higher fees attached to a variable annuity. And the last one is what we call an immediate versus a deferred annuity. So an immediate annuity says, hey, I'm going to give you this money, but I want to turn around and I want to take an income from that, like right now. That's immediate. So your income starts now. A deferred annuity says that your income starts later, like at retirement. Remember the example I gave was, at age 50, you put $100,000 into your own pension. And then at 67, you begin to take income. That's a deferred annuity. Okay. So those are the different types of annuities that are available to you. Now, let's talk about why an annuity? Why would someone need an annuity? Well, the first reason is income security. Annuities provide guaranteed income that you cannot outlive. So if you put 100,000 in an annuity, and when you begin to draw income on it, it's grown to $400,000. And you're taking, $30,000 a year in income from that annuity. You're going to run out of that, $400,000 a year in a certain period of time. But even if you do, and even when you do, you will still continue to get that income until you pass away. So that is what the guaranteed income that you cannot outlive provides. And that's what the income security provides. It helps address longevity risk. People are concerned about retirement and not just having enough, but having a steady income stream in retirement. And so annuities can provide that for the right person. It also offers you market protection. So the reason why someone would need an annuity would be market protection. It reduces the fear of market crashes in retirement. One of the things that we find is when folks retire, and they may retire with millions in their various retirement accounts, 401ks, IRAs, brokerage accounts. But if the market should change the next day, and you retire with $1 million in your portfolio, and the market the next day after you retire decreases by 20%, your portfolio drops. And so when you have an annuity, it reduces the fear of market crashes in retirement because your money is protected. You have guaranteed income. It also is especially useful for women who expect to live longer. Now, I don't know, ladies, if you've heard this statistic from me before, but 80% of men die married and 80% of women die single. And so we tend to outlive our male counterparts. And because of this, having a guaranteed, stable stream of income is important to some women. And this can provide that for you. Now, the other thing is that it has some behavioral benefits. The reason why you may need an annuity is because you don't want to succumb to panic selling. You don't want to get, especially the closer you get to retirement, you don't want to live in fear. You don't want to start selling things and liquidating things in your retirement account out of fear and worry. And so an annuity will help prevent that panic selling. It also can provide some emotional peace, right? Because you know that this money is guaranteed no matter what happens. I have a friend whose spouse passed away, and he had worked for 35 years in his industry. He had a pension with his job, and he had an income for the rest of his life. And when he passed away, a portion of that income, about 50%, went to his spouse for the rest of her life. So it does provide some emotional peace, not just financial returns. Okay. So they often make sense for people who are near or in retirement. So I will tell you that annuities are not necessarily things you want to do for a young person. A 30 and a 40-year-old, not going to be a good person for an annuity. An annuity is a very conservative strategy. And again, it is a way to provide stable income. When you're 30 and when you're 40, you're in the accumulation phase of your life, and we want to do everything to maximize and accumulate as much money as possible. And annuities don't necessarily do that at the rate that you could get in the market. So they often make sense for people who are near or in retirement. They're good for conservative investors, people who are scared of all of their money being in the market. They're also good for widows or divorcees seeking stability. I have someone else that is a widow, and, husband took care of her very well, but she wanted to make sure, and she wants to make sure that she has a certain amount of money every month, no matter what. And so we established an annuity for her. It's also good for high earners who've maxed out other retirement vehicles. Listen, they say there's a saying. I was talking with someone today, and they said, my friend said you need to have 5 streams of income. And that may or may not be true depending on the person, but definitely having multiple streams of income in retirement is going to be beneficial. And having your own pension plan, whether it's through a job and you can also set up your private pension using an annuity, is a good way to diversify your income and your portfolio. So that's who annuities may make sense for. Hey, ladies, I want to take a quick pause to share something exciting with you. If you've been enjoying these conversations and you're ready for a community of like minded women who are growing, thriving, and building wealth together, then you need to join us in the Prosperous Woman Collective on Facebook. It is a safe space where ambitious women connect, share resources, celebrate wins, and encourage each other on the journey to financial confidence and prosperity. You don't have to walk this journey alone. Come be a part of the sisterhood. Just search Prosperous Woman Collective on Facebook and request to join today. I cannot wait to welcome you in. So let's talk about some common myths about annuities because I don't know if you've heard them, but I hear them all. When I first started in this industry, I honestly started on the insurance side. I was really passionate and still am about insurance as I lost my spouse and we didn't have any life insurance at the time. No one had talked to us and communicated with us. And so my mission in life was then and still is to make sure that people are properly protected and transferring the risk to a life insurance company instead of absorbing all of that risk themselves. And so annuities have gotten a bad rap. They are, like I mentioned in the beginning, an insurance product. They can only be purchased by insurance companies. So let's talk about the myths. So the first myth that I hear all the time is just they're just bad investments. Like you don't want to get in annuities. The first thing is an annuity is not an investment. It is an insurance product. Okay. It is not an investment. So you're not tied to the stock market. There's no return in the way that the stock market moves. It is an insurance product. Now, the insurance company has parameters and they may tell you you will get a certain percentage, a minimum percentage and a maximum percentage credited to your account that helps increase your accumulation value. But I want you to understand they are not investments. They are insurance products. The second myth I hear is that all annuities are expensive. And, the fees for annuities vary. They vary widely by the type and the structure. There are fees inside of an annuity. I mean, let's face it. Let's think of it from the insurance company's perspective. You're going to give the insurance company $100,000. In 20 years, the insurance company says, this $100,000 is going to grow to $400,000. And now you're going to have $400,000 when you go to retire. And on that $400,000, we're going to guarantee that we will pay you $30,000 a year forever for the rest of your life. Even when that $400,000 bucket of money runs out, they still are obligated to pay you. Don't you think they are taking a little bit of a risk there? So there are some internal fees, like lifetime income fees, for them to guarantee the lifetime income. There may be some fees like long-term care rider fees inside of the annuities where it will allow you to use it for long-term care if you were to become ill, which is also something that I believe that all single women, all women and men should really make sure they have. So the fees will vary widely by the type of annuity and the structure of annuity. The third myth I hear is you're going to lose your money if you die. That's it. You're going to give them this $100,000. And if you die tomorrow, that's it. You lose your money. And that is not true at all. In fact, there are annuities where if you put in your $100,000 and it grows to $400,000 and you do not take it out because you haven't started taking income and you die, your beneficiaries can get that as a death benefit. So don't believe that. You do not lose your money if you die. If you have a beneficiary on an annuity, they will get the proceeds from that annuity. If you have a joint survivor annuity, say if you have a spouse and you pass away, that annuity can be rolled right over and transferred to the spouse, and they get the benefit of the income that you would have received. So there are different types of riders and different types of beneficiary plans and payout options that annuities offer, but you do not lose your money when you die because we know you're going to die. The next myth is only older people buy annuities, and that also is not true. If you ever heard of someone hitting the lottery or winning the lottery, and they win the lottery and they give them the option to get paid $250,000 a year for the rest of their life, well, that's an annuity. They are guaranteeing them a stated amount of income for life. That's it. It's an annuity. So it doesn't necessarily mean it's for older people. Someone gets a settlement, a huge legal settlement. A lot of times it may be put into an annuity so that they can get that guaranteed income for life. So it's not a product for just older people, but I will say unless you have a huge windfall when you're young and you need to have a stream of income, then typically someone around 50 years old would be a good age for someone to purchase an annuity, and maybe mid-40s, depending upon the reason. There are some suitability things that we need to go over to make sure it's a proper strategy for you, but it is not something that just older people do. Okay. So that's the first thing. And then the other thing is, I'll never get my money back. I give them my money, and the insurance company takes my money and never gives it back to me. And that also is not true. Annuities have what you call surrender charges. They do require that you keep the money with them for a stated period of time. Sometimes it's 5 years, sometimes it's 9 years. I usually don't go over 9 years, but the insurance company says, hey, you give us this money, we have to leave it there for 9 years. If you need access to it, you can take 10% per year. Generally, that's pretty standard. So you can take 10% of the value of the annuity each year if you needed access to your money. But generally speaking, it should stay there for 9 years because this is a strategy to create stable, consistent income. This is not an investment product, so we don't want to go in and out. And if you should decide to liquidate it before the surrender period, then yes, there will be a fee. Just like a CD, if you've ever had a CD and it's a 60-month CD and you take it out in 48 months, well, you're going to pay a penalty to access it. It's the same concept with an annuity, but you do not lose your money in an annuity. So I just want to make sure you understand that. At least that's a myth. I'm sure there have been crooked people out there, but the annuities that I'm aware of and the way that I've structured them, for the people that I structure them for, there's no loss. It's stable income and death benefit and long-term care and all these other wonderful riders that are attached to them. So let's talk about when an annuity is not a good fit, because this is not a strategy for everyone. This is not something that everyone should partake in. So I want you to understand that. I'm not selling you on an annuities. This is another tool in your toolbox when it comes to diversifying your income and coming up with a strategy to create retirement income or to create legacy, however you want to do it. So please understand that. But there are times when an annuity is just not a good fit. And there are a few. So the first one is short-term money needs. Listen, if you're going to put this in there and you know you're going to need that money in the next year, an annuity is not for you. This is money that you have to be able to put away, close your eyes, let it grow, and then begin to take income at a stated period of time. So if you have short-term money needs, this is not going to be a strategy that I would recommend. If you don't have an emergency fund, this also is a strategy I do not recommend. And what I mean by an emergency fund is if you are a single woman, then you should have 6 months of fixed and variable expenses set aside in a high yield savings account that you do not touch unless there are emergencies, job loss, illness, something of that nature. If you do not have an emergency fund, adequate savings, an annuity is not something that I would recommend. If you have high debt to income ratio, so if you have a high debt ratio, if your consumer debt is 20% of your net income, I do not recommend an annuity. If your total debt is more than 36% of your income, meaning house, credit cards, car payment, if it's more than 36% of your gross income, I do not recommend an annuity. If you desire some maximum liquidity, like you need the money to be liquid and you need as much liquid as possible, an annuity is not going to be a good strategy for you. If you already have like a Social Security and a pension and that sort of thing, and you don't necessarily need another pension stream of income, I would say it may not be a strategy that you should use. But I will say this, the biggest reasons why I would not recommend an annuity is if you do not have an emergency fund, if you do not have a good debt to income ratio, and if you feel like you're going to need this money soon, like in a year or in 2 years, never put it in an annuity. You can get it out. You can get your money because it's your money, but you're going to pay a penalty to access your money. It doesn't make sense. And the insurance company goes through a suitability requirement. It is a very thorough check to make sure that you are the right person for that strategy. And I do that for my clients, even before it gets to the insurance company. There are times where I said, yeah, you want it, but right now you're not ready for it. So those are when annuities are not a good fit for someone. So let's talk about how annuities fit into the bigger plan, right? The whole goal, right, is to make sure that you don't eat dog food and cat food in retirement. The whole goal is to take care of yourself and then perhaps leave a legacy for those coming behind you, right? That is the objective. So when we're talking about the bigger plan, that's what I mean, the bigger plan. An annuity is just one tool in the toolbox. An annuity is just one strategy available to you when it comes to creating a retirement lifestyle that you want and you deserve. So an annuity should complement your investments, not replace them. It should never come in place of an investment. It should be a nice added bonus. It should be an add to your investments, not a replacement. Again, annuities should complement, not replace investments. And I really want you to hear that clearly because sometimes people come to me and that's all they have are annuities. And people that's all they sell them is annuities. Yes, you need an annuity. Everything is an annuity. You can't use one strategy for all aspects of a person's life. So an annuity should probably be one of the last things that you do when it comes to retirement planning and strategy. It should never take the place of investments, though. It should always complement other things. So when we're looking at the bigger picture, right, and we're looking at what your retirement looks like, well, it's comprised of a couple of things, right? It's comprised of one, Social Security. How much is that going to be? The next thing is going to be your investments, your 401ks, your IRAs, your brokerage accounts, any REITs that you're doing. The next thing would be emergency savings, right? Having that together. Then making sure you have the proper insurances. That would be life, disability, long-term care. And then making sure you have an estate plan in place, right? So when we look at your bigger picture, this is the big picture. Those are the things that are within the big picture that you should have or be planning for holistically, okay? But the question it becomes, once you have all of the other things down, once we've looked at your life from that holistic view that I mentioned, the main question you need to ask is, what problem is this annuity going to solve? What problem is this annuity going to solve? And some people, the problem is, I'm scared I'm going to blow through my retirement. I'm scared that the market is going to tank and I'm going to lose all of my retirement. So I want to put some of this money in a product where I have a guaranteed stream of income, a stable stream of income. So that's the real question you need to ask yourself. It's not just, hey, they told me to do it and that's what I'm doing. We really need to look at this from a holistic view. You really need someone who looks at your financial situation holistically and then asks you or help you discover what problem you have and then create strategies around solving those problems. So annuity is not a problem-solving strategy for everyone. It is a problem-solving strategy for the right person. And that's what I really want you to understand. So to wrap up, I want to tell you a couple more things. I want you to understand that annuities are tools. They are a tool in the toolbox. They are not traps. Okay, they are not traps. They are tools. I want you to know that the right annuity can provide confidence and peace of mind. I mean, just think about it. If you know at 67 or 70, you're going to have Social Security income and a guaranteed stream of $50,000 a year until you die, well, that can give you some confidence and peace of mind. Now, the wrong type of annuity sold incorrectly will cause some regret. And I have run into people who have had that. They didn't understand what they got into and they regret it because maybe the timing wasn't right or the product type wasn't right for their goals. So that's why it's very important when you start looking at strategies and you're working with someone, they are looking at your total financial picture, just not one aspect of your financial life, that they are taking an inventory of your goals and your dreams, that they are analyzing your finances. They're analyzing your current courses of action. What are you doing right now? And then what do you want to do in the future? You need someone that looks at you holistically, comprehensively, not just from one angle. Because today they may think this is great, but if your circumstances change and you are not in constant communication with someone and regularly updating them, and they are not regularly checking in and helping to understand where you are financially, then yeah, it could be something that you regret. The other thing with annuities is that the stream of income that you receive really doesn't have an inflation hedge on it. What I mean by that is we all know that, when I was coming up, I could have 50 cents from my uncle. He'd give me 50 cents and I could buy a bag of Wise potato chips, a quart of water, 2 packs of Now Laters, and some blow pops. And I was in heaven, right? All with 50 cents. Now it costs $3 to buy a bag of potato chips. You see where I'm going? So what 50 Cent did years ago, 50 Cent cannot do now. That's the only challenge with annuities. Annuities have a stable stream of income, but what $50,000 could do for you today in 20, 30 years, it may not be able to achieve all of those objectives because there's an inflation. And that can be a challenge with annuities. So making sure you have the right type that has right riders on it is going to be very important. But that is the main, I would say, disadvantage of an annuity is that it doesn't keep up with the pace of inflation. 50,000 is 50,000. You're going to get that for the rest of your life. And if you die and you have a joint survivor annuity, well, then that 50,000 will be divided in half for your spouse and they will get 25,000. That's just the way annuities work. But they just don't keep pace with inflation. So that's why there's only one tool that you should have in your toolbox, and it should complement those other investments and not take the place of them. So, what I want you to do is I really encourage you to ask questions. I really encourage you to dig deep, to discover annuities and find out if this could be a good strategy for you. I would invite you to have a confidential conversation with me to learn more about one, what I do and how I help people, but most of all, find out if an annuity is a strategy that is good for you, maybe now, or if it's good for you in the future. So that way, in the future, a plan can be developed to then approach getting an annuity for yourself. So I definitely invite you to have a confidential conversation. I want you really to understand that I am an educator first. So this is not an effort to sell in annuities. I'm not trying to push you into a product. I just am educating you again on a tool available to you, a strategy that you can implement on this financial journey. So what I'm also going to do is include in here a downloadable annuity fit checklist. And I'm going to provide that in the show notes. I would encourage you to download it. There are questions on there that you can answer, and that will help you understand before you even have a conversation with me whether an annuity is a strategy that you think you need now or later or you want to learn more information about. So I would definitely encourage you to download the worksheet that is in the show notes so that you can, just go through the checklist and see if it makes sense for you to have an annuity or for someone that you may know. So that's really it. I really wanted to start this year off with educating you on the different strategies and tools available to you as we begin this new year. Everyone has goals and things that they're going to do in their resolutions and all of that. I hope this year that you resolve, if you have not, to begin to get your financial life in order, to begin to come up with a plan for how you want to live, what your retirement looks like, what your future looks like from a financial perspective. We know finances impact every area of our lives. And, you heard the saying, if you don't have a plan, that means you plan to fail. I don't want you ladies to fail. I want you to succeed, and I'm here to help you. So if you'd like to talk about annuities, or you just like to learn more about what we do at Woman to Woman Financial to help, high achieving women create and grow wealth, you can also click in the show notes. I offer a complimentary financial conversation to learn more about you, determine if there's synergy, and find out if I can even be of assistance. And if I can't, then I always have a plethora of people that I can refer you to. But I definitely want you to take this year, the beginning of this year, and really commit to creating the financial life that you deserve. Thanks so much for listening. And until next time, Happy New Year and much success. Thanks for listening to Becoming a Financially Confident Woman. I know from experience that confidence with money can change everything. Be sure to subscribe, share this podcast with another woman who needs encouragement, and visit Woman to Woman Financial to schedule your confidential financial conversation. Remember, you are becoming a financially confident woman.